Hello everyone, and welcome to Day 3 of the Momentum Investments Annual Investment Matters Conference. Now today we shift gears and talk all things about creating multi-asset class solutions. Multi-asset class funds are where all the thinking about the best practices and approaches, trends and future insights all come together to create funds that are ultimately the vehicles into which investors will invest. These funds are diversified and integrate all the different investment opportunities and types into a comprehensive offering that will meet a variety of investors' needs and requirements. Now, a gentle reminder, especially to many of you who have been joining us over the last 2 days, that we have applied for Continuous Professional Development or CPD points. So please do ensure that when you watch our full sessions, you ensure to add your ID or FSP number to the CPD section so we can verify your attendance. The CPD certificates will be mailed to you after the Financial Planning Institute's accreditation is finalized. But before we get into the program, a reminder that even though we are meeting on a virtual platform, we still have the opportunity to interact, network, and ask questions. So please be sure to post your questions to speakers in the questions and answers section, and feel free to use the chat function to network with your peers. As we start today's conversation, it will be led by Sonja Saunderson, Chief Investment Officer at Momentum Investments. She'll start today off and discuss how all the different components of investing come together in the multi-asset class construct. As the Chief Custodian of the Momentum Investments outcome-based investing philosophy, this is the main framework of how Momentum Investments brings its multi-asset class funds together.
Thank you, Gugu. Carlos Slim said, with a good perspective on history, we can have a better understanding of the past, the present, and thus a clearer vision for the future. During the last 2 days, our asset management and alternative investment teams have discussed how we are adapting for the future and integrating responsible investing and environmental, social, and governance principles to craft sustainable investment outcomes for our clients. They discussed new investment opportunities, challenges we see in the market, as well as how we respond to these to enable sustainable development goals and help revive our ailing economy for tomorrow. Today we focus on our multi-asset class skill set and how sustainable and responsible investment practices are interwoven with every portfolio decision we make. You will hear how a broader menu of investment opportunities and asset classes help our investments to be meaningful and impactful beyond just financial returns. Momentum Outcome-Based Solutions has been pioneering the multi-management industry in South Africa since 1998. We are proud of our pedigree of thought leadership over the years. We have been the pioneers of outcome-based investing philosophy and approach in South Africa, and we have a successful long-term track record in delivering client portfolios designed with this philosophy as the backbone. We were the first multi-manager to adopt alternative asset classes as mainstream strategies into our multi-asset class portfolios in 2009. We helped to craft the South African industry with smart beta completion strategies that set the stage for some of the best performing listed equity strategies in the market, successfully integrating these into multi-managed equity portfolios over time. The core of the investment team has been together through many investment cycles since the early 2000s. We have local and global investment experts that work in unison to creating sustainable investment outcomes for our clients. And we are now the longest standing signatory to the United Nations Principles for Responsible Investment in South Africa. We have an integrated set of policies and enabling principles to factor social, environmental, and governance principles into our business as well as our investment processes. At a policy level, several key initiatives guide the way that we operate our business and investment decision-making process. We are guided by our responsible investing policy and principles in following an integrated approach in making investment decisions across asset classes and investment managers. Secondly, Our climate change policy guides us in terms of how we integrate climate considerations into our decision making. We have signed the Just Transition Statement that navigates us in considering decisions impacting the move away from fossil fuels in a manner that will not be harmful on communities and workers. And we have formally adopted the Task Force for Climate-Related Financial Disclosures. But where are we now in terms of the evolution of multi-asset class investing? Several years ago, we started talking about the lower growth environment, and now we, as your investment manager, must find good diversified opportunities for growth to use in our portfolios. In pursuit of this, we embarked on using higher yielding, often more illiquid, non-traditional asset classes in our portfolios. Although it gave us the much needed diversification and return characteristics that we needed, it often came at the expense of liquidity and a higher cost. This, however, focused us on being even more innovative in adding lower cost opportunities in asset classes where alpha is more scarce, and to work on liquidity profiles across different asset classes in a lot more detail. I would argue that the biggest challenge in multi-asset class portfolio construction today is to match the suitability requirements and diversification needs with the requirement to construct a portfolio that complies with investors' sustainable investment priorities. Long gone are the days when the focus is purely on maximizing returns and minimizing risk over the investor's required investment horizon. Now the focus is on delivering on the investor's requirements in a cost-efficient and diversified way, using asset allocation and risk targets alongside investment strategies that also improves the world. So today we want to discuss how we find that balance as fiduciaries to our clients between the financial returns and the societal and environmental impacts that form part of an outcome-based journey. We want to focus on the key trends that our research shows us to be mindful of and discuss the integration principles that belies our investment belief system. Also make sure that you get our latest issue of the Mindfields research publication and our stewardship report, where we demonstrate our research and progress in our responsible investing practices. Through the course of this conference, I hope that you will have observed how we follow responsible practices in our business by focusing on gender as well as transformation of our team and developing talent for the future. A bit later, our two interns will give a conference overview so you can see firsthand the talent that we are seeking out and developing to position our business for the future. I hope that you will enjoy this session with us today.
Human behavior has a massive effect on the outcome of an investment, as fear and greed sometimes drive undesirable investor behavior. Now, Momentum Investments has researched this phenomenon to fully understand how to better equip advisors and their clients on how to manage their emotions, especially when they run high. Investing is personal, and nothing is more personal than how people act when facing uncertain market conditions. In this video, our resident behavioral scientist, Paul Nixon, unpacks this in a lot more detail. Take a look.
We fix bad behavior. Now, from this statement, there were two obvious questions. The first is, who decides if that behavior is bad? Well, we do. But in most cases, it's very clear when people are demonstrating a behavior that is not in their best interests. Last week, I reviewed a client file of a pensioner that lost about 2 million rand of their 7 million rand in retirement capital. That's about a third, by moving all of their money to income funds when markets fell last year, in March. This is a substantial behavior tax that we need to eliminate and get rid of. The second question is, how do we fix bad behavior? The answer here lies part in a deeper understanding of what investors actually want. Now, the 80s and 90s saw the world fixated on mental shortcuts and processing errors that exposed us as irrational. But the new wave of behavioral finance is more focused on real people and what they want. So what do we want from our investments? And this has been shown a lot in research. Firstly, we want security. Human beings are terrified of losses. A global survey conducted in 23 countries showed that people will only give up about 12% of their wealth for a shot at a 50% wealth boost. So fear dominates greed. Secondly, we want to stay true to our values. People also get expressive and emotional benefits from investing. Our investments can say something about us and also make us feel a certain way. Think about responsible investing in terms of environmental, social, and governance factors, or ESG. Thirdly and lastly, we want social status, even though we don't like to admit it. Western culture ties our own well-being to that of our peers. Now ask yourself if risk for investors is best measured in variance of a portfolio, or rather in terms of not satisfying these very important wants. And these are really the bridges that we build. Behavioral science should really be the keystone of every business. US-based research published in the Challenger Cell showed that firms claiming openly to be customer-centric primarily communicated information about themselves, their own products and services. But true customer centricity really is about telling customers something about themselves, and that really is making it personal. This is far more effective as a signal of our intention to help them satisfy their needs and wants. With a deeper understanding of our customers or investors and how they are processing information at different points of the market cycle, we are able to intervene and help them minimize errors. In doing so, we can do a few things. Firstly, design more appropriate investments. Think of mapping out the set of foods that give the best nutrition at the lowest possible cost. Is there any point if no one wants to eat them? What if another constraint is that the diet should be palatable? This may give a very different set of foods. This is no different from constructing portfolios. Mean variance optimized portfolios are little use if investors can't stick to them. Secondly, we need to give better advice, or we can use this information to give better advice. Understanding the investor's psychological makeup and predisposition to cognitive and emotional errors is crucial for the wealth manager of the future in their role as a financial therapist. The investor should happily pay investment fees for an advisor that is able to diagnose the client and have the right conversations along the investment journey to ensure they reach their goals. And finally, we can deliver better marketing and communication strategies. Saying the right things to the right people at the right times and presenting information and alternatives to customers when they need it most to make better decisions is really the key to truly making it personal. How are we going to use behavior patterns to give better advice? The behavior tax happens when investors trade off an immediate emotional need for financial security for future investment returns. To manage and ultimately eliminate this cost, however, it is crucial that we understand the investor's risk behavior. We all have long-term, relatively stable preferences for risk. We either like it or we don't, and this is linked to our personality. Extroverted individuals, for example, have been shown to be quite tolerant for risk, while neurotic people, for example, are quite risk-averse. Whatever our long-term risk preferences are, however, the short-term is usually where things go very, very wrong. COVID-19 happens and our long-term preferences go out of sync with the risk we are perceiving in markets around us. When we perceive losses, our behavior changes, and we use something called prospect theory to quantify when investors begin experiencing a loss, and so when their behavior is going to change. Interestingly, this point doesn't have to be a 0% return. In fact, we calculated investment returns separating gains and losses in South Africa to be around 12.5%. As returns dip below this point, investors become 9 times more likely to switch their investments to something performing better, which exposes them or could expose them to the behavior tax. We've identified 5 distinct behavior patterns over market cycles, from avoiders who get stuck in safe assets for long periods of time to assertive investors who are always on the lookout for the next top performing asset. Once we've linked these behavior patterns to psychometric personality traits, we have the basis for what we need to predict an investor's behavior based on their personality alone. We can then intervene before investors make decisions that would result in a behavior tax.
Malik Baji is the Managing Director as well as Head of Europe and Africa Institutional at Robeco in the Netherlands. And Nina Saad is the Head of Institutional Portfolio Solutions at Momentum Investments. Malik and Nina will discuss some of the key trends and developments that have been shaping and continue to shape and influence multi-asset class funds. Malik brings the world-class and global perspective of Robeco, with Nina providing the local investment perspective on how these funds are shaping and will continue to shape multi-asset class funds.
Thanks, Gugu, and good day, everyone. Hello, Malik. Thank you for joining us from Frankfurt, which fortunately is in the same time zone as here in South Africa, so neither of us had to dial in at a crazy hour. Malik, let me jump right in and ask you, what are the investment trends you are seeing play out globally?
Thank you, Nina, and thank you, Momentum Investment. We're delighted from Robeco to be invited to this session and the broader relationship as well. I can tell you one thing, I would prefer to be in South Africa right now than in really Frankfurt, but there it is, the world that we live in. In terms of your question on the key trends we're seeing in the market, let's take a step back. I mean, the fallout from the COVID-19 pandemic, changing product demands from investors, and a really challenging global regulatory environment has really contributed to making 2021 a tumultuous and unprecedented year for the asset management industry. The changing environment will actually also offer many opportunities for growth. And surprisingly, very surprisingly, the asset management industry is coming out of the crisis in a position of strength, having proven its ability to weather precarious conditions. So simply, what are some of the trends we're seeing? I'll bucket into three core elements. One, the search for yield, diversification, and different sources of income in the continued yield environment. Asset owners and insurers find themselves under increasing pressure to deliver higher yields. Low interest rates have cut into their product margins, particularly in the case of spread products with long-term guarantees. As insurers and asset owners search for desirable investment targets, alternative investments such as private markets could be an ideal match. Within the universe of alternatives, private markets have enjoyed a particularly remarkable run over the past decade. I think AUM growth has been roughly around 12% annually to reach close to 8 trillion last year. With interest rates likely to remain low for the foreseeable future, we see no sign of this force slowing down. We believe the next big wave will likely come from retail investors who have likely remained on the sidelines. Simply, with the search for yield continuing, we will see more alternative investments. The second and most critical component is ESG investing. Specifically, investment considerations for climate change is currently the biggest fundamental change in the industry. Sustainability investing has now become the standard in the asset management. And frankly, Nina, regulation has been a key driver of it. A growing array of regulators are forcing the pace with environment and other environmental, social, and corporate governance disclosure requirements for financial affairs. Forward-looking asset managers have made ambitious commitments. You've heard of Net Zero Alliance, One Planet, which really require action. Asset managers whose own ambitions have driven significant efforts to augment their investment process will be able to support their clients by becoming ESG advisors, not just product providers. So really, climate and sustainability are rapidly becoming key differentiators. The most advanced asset managers are cultivating partnerships, leading to climate research institutes, owning their proprietary tools and service offerings can really make clients become more climate-aware investment and portfolio constructive decisions. Hence, we're seeing a significant growth in interest in climate, net zero, and decarbonization. Simply, ESG is here to stay. The final element in terms of a key trend that we've seen over the past 10 years is really around the shift from active to passive. Many asset managers talk about an active products renaissance, but we expect both active core and specialty products to be the slowest growing element. We continue to see investors get skepticism about the value that active managers bring on the table. So the real result of that is the claim against active management continues. Passive continues to be king. And as we see passive management continue to grow, attracting cost-conscious investors, not only interested in paying higher fee models, an alternative to passive is also continuing to grow, Nina, and that is in the context of smart beta and enhanced index investing. This approach enhances the risk return of an index by implementing small and over and underweight position with respect to the index, while maintaining the tracking error at a lower level. We're continuing to see that consistent increase. So passive investor continues to grow. It simply is the fastest growing asset class over the next 5 years. And interestingly as well, smart beta also has become a key attractive alternative for investors globally. I'm interested to see, Nina, how is the shift to passive and smart beta investing playing out in South Africa?
So Malik, South Africa is most certainly following suit. The focus on costs and the shift to passive and smart beta investing may not have started as early as it did globally and not as well entrenched, but it is here. Our OBI philosophy and portfolio construction is anchored in a risk premium approach, so the inclusion of passive and smarts is what we do, and we have for many years successfully included them as a key component of our portfolios. A decade ago, we developed a comprehensive range of outcomes-based portfolios that have a solid track record that we are very proud of. Our factor range of portfolios starts with a pure passive range, where the strategic asset allocation is implemented on by tracking market cap indices. And then we progress to the next stage that has the same strategic asset allocation, but uses predominantly smart beta. And then in our best view portfolios, we blend passive with smart beta, with traditional alpha strategies and new asset classes. Importantly, when blending the strategies, we ensure that when we identify specialist skills, there needs to be demonstrable net of fee alpha. And the investment managers also need to uphold responsible investment practices and integrate ESG into their processes.
No, I agree, Nina. Nina, ESG is not a buzzword anymore. ESG is a mega trend here to stay. Let's put it in perspective. Global ESG assets are on track to exceed 53 trillion by 2025, representing a third of the 140 trillion in projected total assets under management. And the reason why is simply a perfect storm created by the COVID pandemic and the green recovery we are seeing in the US, EU, and China will likely reveal how ESG can help assess a new set of financial risks and enhance capital markets. Interestingly enough as well, Nina, sustainability investing has massively broadened its horizon to focus on ESG factors that are increasingly integrated in the investment process across all asset classes. It is simply the fastest growing segment in the investment world with wide adoption across strategies and asset classes. At Robeco, we're pioneering the field, adopting sustainability investing since the mid-90s. When Robeco acquired Robeco SAM, the acquisition of SAM gave us the knowledge and insight we needed to integrate sustainability in all aspects of our business. Today, our sustainability insight approach, which uses ESG building blocks, is applied to the majority of our strategies. As of June 2021, we manage more than 190 billion euros of assets integrating ESG. We tailor our solutions with our clients to individual risk projects and sustainability investing needs while ensuring ESG information is consistently integrated into our process. For example, Nina, as you well aware, we co-launched with Momentum Investment, a global multi-factor equity portfolio which incorporated full ESG integration. The Momentum Global Multi-Factor Portfolio offers all the advantages of sustainability as well as a superior return compared to passive vehicles by incorporating 50 years of academic insight from Robeco and the integration of ESG. The superior return is achieved by overweighting these index constituencies for critically having an ESG integration component. So the question is how? How do we integrate ESG in this innovative solution? First, the strategy adheres to the general Robeco exclusion policy. This policy entails the exclusion of companies that do not comply with broadly accepted international treaties, in particular treaties on controversial weapons, the exclusion of countries against which the UN Security Council issued a resolution, in addition to Momentum's own client-specific exclusion list. Second, we integrate our proprietary smart ESG scores. In our stock ranking model, we take ESG into account. Third, we ensure that the score on ESG is higher than the benchmark. The ranking model proposes a high-ranking stock and overweight when constructing the portfolio. With this enhanced form of ESG integration, we avoid the risk of being overexposed to less sustainable companies. Fourth, which is also very critical, we integrate the carbon footprint in the portfolio construction process by ensuring that the greenhouse gas environmental footprint of the portfolio is lower than the benchmark. And fifth, a direct link between the enhanced engagement program and the portfolio is applied. because Robeco believes that engagement and voting are critical elements of a successful sustainable investment strategy and can improve a portfolio's risk return. So we do not overweight companies on an enhanced engagement for the duration of the enhanced engagement process when rebalancing it. And finally, 6, which is a critical component also for momentum, is we're able to reflect investors' preferences in a variety of different dimensions, such as exclusions, integration, footprint reduction, and also critically the UN Sustainability Development Goals. Nina, I'd be curious to see, how does momentum integrate ESG into your own multi-asset portfolios?
So Malik, we favor a broad-based and importantly a fully integrated approach to ESG. What this means is we make sure it is applied at every decision point of our investment process. Our portfolio construction process comprises of 3 steps. These are multi-asset class, multi-strategy, and then multi-mandate. I'm going to go through each of these steps and explain how we integrate ESG at all the different decision points. In the first step, when we set our strategic asset allocation, we focus on not losing money for our clients, so capital at risk is a key input in our risk budgeting process. Another key input in setting our strategic asset allocation is our long-term expected return of each asset class. And importantly, the effects of ESG factors are a key consideration in establishing our risk-adjusted capital market assumptions. So this is almost the top-down view, if you like. The next 2 steps of our process, the bottom-up view, is identifying the strategy or the mandate we will be deploying within each asset class. At the multi-mandate level, we believe active ownership is the most important lever to successfully integrate ESG in our selection, appointment, and monitoring process of our investment managers. To facilitate ESG integration, we developed an in-house proprietary responsible investment rating model to establish the level of RI practices applied by the various investment managers. Now, the scope of responsible investment practices is very wide, so this model is designed to assess the investment manager's overall responsible investment framework and the ability to evidence their RI practices. The indicators our RI rating model considers are, is ESG in the culture of what they do, or is it just a tick box approach? Is there oversight and accountability to ensure RI practices are upheld? Do the portfolio managers and analysts have the skill set to identify and interpret the ESG risks? And then, to what degree do they use their rights to influence the activities of the companies they invest in? It is important that there is alignment between us and our appointed investment managers. So in our investment management agreements, we mandate the managers to adopt our RI policy. We very importantly maintain and have insourced our voting rights when it comes to governance resolutions and vote according to our own proxy voting policy. However, the investment manager votes on corporate actions that have a direct financial impact on the portfolio. Where we are not able to mandate the investment manager to align with our principles, then their approach to ESG is a heightened consideration in our selection process. Now, most managers, investment managers, do recognize the importance of RI practices, and they do integrate it into their processes. Some articulate it better than others, but there's still work to be done, particularly with the evidencing and reporting of these stewardship activities. As I mentioned earlier, this RI rating model gives us the framework to select, monitor, and actively engage with the investment managers. The goal is to ensure that our appointed investment managers come along with us on the RI journey. We just recently completed our annual RI review, and we are very pleased to see that year on year, the average manager RI rating is ticking up. We also always provide recommendations to the managers on areas of potential improvements, and recent feedback we received from them on how they have implemented on our recommendations, we see that some managers that were previously not PRI signatories have now signed up, we are seeing more managers posting their proxy stats and ESG policies on their websites, and RI practices are now becoming part of the investment team's performance appraisals. To further supplement our active ownership and striving to be agents of change, in our Best View range of portfolios, alongside our traditional alpha strategies, we also have a direct allocation to new asset classes and direct impact strategies. The themes we are capturing in our direct impact strategies, which Motlatsi spoke to about yesterday, include alternative energy, social infrastructure, and diversified infrastructure. Now, these impact funds are very long-term in nature, and as one may expect, are not very liquid. This is a challenge, particularly here in South Africa, where we need to be very cognizant of liquidity, given our shrinking savings pool. Now, the way we solve for liquidity is by 1, sizing the allocations appropriately, and 2, ensure we have several differentiated and well-diversified impact sub-portfolios. The beauty of this structure is that each sub-portfolio has its own liquidity profile, which in itself then creates a level of liquidity. The added advantage of this approach is that it also lends itself to co-creation, where we can pick and choose and tailor-make it for a particular client's need. So, for example, a university pension fund client may want to use part of their impact investment allocation to more directly capture the social infrastructure theme and invest only in student housing. So you can see that with this approach, this can easily be done. Malik, what particular social themes have you seen develop recently?
You know, Nina, the pandemic has exposed at no time in the recent past has a growing gap between the haves and have-nots been more apparent, really threatening social stability and prosperity. Hence, really fundamentally, there's been a call to action among investors. And so some of the themes we're seeing, some investors are turning to the US Sustainability Development Goals as a framework for developing their approach to addressing inequalities. Second, we've also seen an explosion of social bond offerings in the last year. Many actually focus explicitly on mitigating the negative impacts of the pandemic. Early signs reveal investors' growing appetite for these instruments. In October 2020, for example, the EU issued roughly about 17 billion bonds in social bonds, the largest ever social bond issuance to date, aimed at really providing pandemic relief, explicitly tied to SDG 3, which is good health and well-being, and SDG 8, decent work and economic growth. But frankly, Nina, the biggest theme on the S side is diversity and inclusion. The public's heightened expectations for companies have dovetailed with the growing interest of investors, ESG factors, which include diversity and inclusion, particularly as the ongoing global pandemic has hit women in the workforce really hard. Let me put it in perspective. According to a report from the UN, women are overrepresented in many of the industries that have suffered the most from the pandemic. We're talking the food service, retail, and entertainment. The overall job and income losses have resulted in 47 million women and girls being pushed into extreme poverty, further widening the gender poverty gap. So can you imagine, following the decades of hard-won battles for gender equality and women's economic rights? This is a cycle we can't let slide back. Hence, there is a growing focus to accelerate the pursuit of diversity. Isn't just about doing the right thing. A diverse workforce can drive better outcomes that can actually enhance business growth and brand reputation. Despite the growing momentum around diversity and inclusion, many organizations, and frankly, Nina, on a global scale, we're still lagging. Maybe we can learn a bit from South Africa. South Africa is clearly at a more advanced stage. How are you incorporating the issue of diversity and inclusion in your portfolios?
So Malik, importantly, in South Africa, a key ESG factor is transformation. This talks to not only the change within our company, but also supporting BEE investment managers. Across all our portfolios, to ensure focus and accountability, we have a documented transformation plan that sets ownership targets as the high-level metric. In line with our overarching approach to ESG, where we believe in a fully integrated approach and active ownership as the key lever, we do similarly with the transformation theme. We favor broad-based transformation, and to that end, we have developed a detailed dashboard to monitor more granular metrics, which facilitates and focuses our engagement with our investment managers, which will lead to more diverse and transformed investment teams and more women in senior decision-making positions across both the large established firms as well as boutiques. Malik, let's move on to the issue of cost. It would be amiss of us to not address the elephant in the room and the question on everyone's mind. Does ESG, impact investing, and sustainability come at the expense of return? Does it mean sacrificing performance? Millennials are requiring it. Investors intuitively know it's the only way forward, and we as investment professionals appreciate the risks associated with not embracing this approach. Impact investing at Momentum Investments is entrenched in every decision we make, as we believe it leads to better informed investment decisions, which in turn leads to improved portfolio risk-adjusted outcomes in the long run. As fiduciaries of our clients' investments, we seek to maximize the probability of delivering on the predefined investment objective and stand firm in that whatever we do, the investment case prevails at all times. Malik, what is the global experience when it comes to the performance front?
Simply the belief that, for me, Nina, from a global perspective, the belief that considering ESG factors will detract from potential long-term investment performance can actually hold people back from investing responsibly. It shouldn't. If you think the most successful investing strategies are those that pay little heed to the planet and its people, I would challenge you and everyone across to think again. The view that you must expect lower returns if you want to invest responsibly probably Nina stems from old debates around so-called ethical investing. But ethical approaches, which tend to focus more on moral judgments, are very different from responsible investment strategies that integrate ESG factors to improve investment decisions and, by doing so, financial outcomes. So what is the reality? There have been many studies done over the past few years that have examined the relationship between the integration of ESG into investment strategies and financial performance. And the conclusion overwhelmingly is it remains a positive contributor to performance. Previously associated with lower returns, numerous studies have supported clearly the long-term advantages of ESG investing, and that is a positive contributor to performance. Put simply, taking sustainability issues into account leads to actually better informed investment decisions and ultimately leads to better returns in the long term. This is why Robeco remains convinced that it works and has integrated ESG analysis in the investment process for all of our investment strategies. So for us, simply speaking, sustainability investing at Robeco is not an offering. It's part of our DNA. It's a way of life. And for over 25 years, we have worked tirelessly to make it a reality for our clients and the broader investment world. That is essential to what Robeco is as a company, and that is essentially to our belief system, and that is essentially what we believe is the future. It is mainstream, it's here to stay. And we encourage all of our clients and clients of Momentum to really embrace this ESG journey and build a platform as we move ahead towards a better outcome and a better world. Off to you, Nina.
So Malik, thank you. And yes, I agree. We pride ourselves on being at the forefront of global best practice, global developments, and prioritize upskilling ourselves. ESG is a journey that we have been on for many years, when we were one of the first South African signatories of the PRI. 2 years ago, we adopted our climate change investment policy, and this year, most of our team members completed the PRI African Climate Awareness course as we continue to learn how to manage the risks and opportunities presented by climate change. Last year, we became one of the first South African signatories to the Just Transition Statement to ensure no one is left behind as we transition to a more climate-friendly economy. A fully integrated approach and active ownership is a natural extension of our outcomes-based investing philosophy. And when properly managed, impact investing can offer the best of both performance and the positive impact outcomes. And when clients connect with their investment strategy, they remain invested, which is a key tenet and pillar of our outcomes-based investment philosophy. And Malik, thank you for joining us today. Enjoyed the conversation, and thank you to everyone at home for joining us today.
Thank you, Nina. Thank you for everyone joining as well.
In our next session, Jaco de Jager, Head of Retail Fund Solutions, and Eugene Botha, Deputy Chief Investment Officer at Momentum Investments, talks to some of the key trends and developments we're now seeing around the world and how this thinking can be integrated into future-proofing and preparing funds for the future. Now, many of these trends find a more direct mechanism into incorporation in global asset classes, and they'll be unpacking how this can be harnessed for the benefit of investors.
Thank you, Gugu. Thanks for joining me today, Yaki. So we have something very exciting and interesting to share with you over the next 30 minutes as we look towards the future. But before we go into detail, let's quickly talk about the evolution of technology and the world we live in. You may remember a certain TV program that aired some 20 years ago called Beyond 2000. I remember it well. Every Sunday afternoon, we were mesmerized with the technology and technological advancements that were showcased. We laughed at the notion of hoverboards and self-driving cars, let alone flying cars that we have today. Not only are the youngsters racing around on hoverboards, but space travel for research purposes have evolved to a 10-minute fun ride, obviously for those who can afford it, not too dissimilar from an amusement park. The future we once imagined impossible is here now, and we know the pace of advancement is increasing. The impact far-reaching, both socially and economically. Technological and economic advancement is not a buzzword or a nice-to-have, as we are experiencing the fourth industrial revolution, a term coined in 2016 by Klaus Schwab, and what is becoming more evident is that it's about more than just technology. Development, as the quote of Joe Kaiser refers, is not limited to just business, economic development, and profits, but it touches massively on the environment and society as well. COVID has made us realize even more prominently that the world is changing. The pace of change is not certain, nor the extent of impact. As investors and custodians of client assets, we also acknowledge that, compared to history, we are in a unique environment that presents us with a massive opportunity to grow client wealth and assets. But we also understand that with it comes a huge responsibility in terms of how our assets are deployed and the potential impact our investments may have on the environment and society in general. The world is changing, and alongside all its ecosystem, we are facing an increasingly complex, connected, and ever-changing world where unprecedented digital innovations are disrupting the value, and at a time when we are facing major human and climate challenges to build the world of tomorrow for future generations. How does that strike you, Jaco?
Thank you for the introduction, Eugene. We are indeed living in extraordinary times, where change is not only expected, but it's celebrated. Disruptive innovations, ideas, and societal changes are embraced in today's world, and this is creating opportunities alongside it. Technological innovations, demographic and social trends, urbanization, and environmental challenges are here to stay, and the importance thereof is being forced into the spotlight on an ongoing basis. We believe the time is right for diversified solutions, such as the ones we manage on behalf of our clients, to start looking at this potential. And the growth of these future trends will shape the global economy and the world at large. So how do we define thematic investing? Is it a fad or flavor of the month? We say no. We believe these are investment opportunities that will persist as disruptive ideas and technological advancements are rapidly reshaping the world. That's the world we all live in. All themes are not created equal. There is a distinction, as some are structural and long-term in nature, and some are shorter-term anomalies. but every change represents an investment opportunity. Thematic investing is the art of identifying opportunities based on personal experiences and aligning investments with your beliefs and ideas. Simply put, thematic investing is a top-down investment approach that helps investors gain exposure to trends and ideas through a portfolio of companies expected to benefit from such changes. Thematic investing, therefore, focuses on broad macroeconomic and market evolutionary themes. It requires the understanding of how macro factors and influences stand to impact the world. The acknowledgement that broader themes play an important role in determining the best investment opportunities, particularly over a medium to long-term investment horizon. Thematic investing allows investors to capitalize on future trends by identifying macro-level themes today that are likely to flourish over the coming years and even decades. It focuses on predictable long-term trends rather than specific companies or sectors, enabling investors to access structural, once-off shifts that can change the entire industry. According to research from BNP Paribas, it was found that there has been a gradual but a very deliberate shift away from allocation based on asset class, geography, and business sector towards a more thematic approach. And with that, there is a growing appetite for sustainable thematic funds. The thematic investment approach saw its rise in popularity after the global financial crisis of 2008. That caused investors' focus to shift away from traditional investment methods. Prior to the global financial crisis, the defining investment principle was focused on determining or forecasting future stock movements by analyzing data patterns from the past. Most portfolios were positioned based on historical information rather than expectations for the future. Today, past fundamentals are still widely being used to classify instruments. As we experienced in 2020, any financial crisis makes forecasting similar future events complex, where anomalous data skews predictions. For this reason, investors have come to base their investment decisions more strongly on in-depth analysis of expected changes in the future. This is where thematic investment becomes a critical tool. It offers a different and complementary approach to classic investment management methods, in that it seeks to capitalize on opportunities shaped by transforming developments in the future. Growth in available funds over the last 5 to 6 years is clear evidence of this shift or transition. With millennial investors' preference towards easy-to-understand, theme-based products and portfolios, the space will surely see more traction in the future. It will be very interesting to see how wealth shifts from traditional sector or country-focused products to thematic strategies. It's important to understand that thematic investing should not be seen or considered to be a substitute for traditional investing. Much like the way active and passive management coexists and complements one another, so too does thematic or trend investing sit alongside traditional investment. Traditionally, institutions and fund managers have been following a relative investment approach, which is focused on either adhering to or deviating from a benchmark or index. One may argue that this approach may have some challenges or shortcomings relative to thematic investing. It has a relatively short-term focus on benchmarking and measures of success working against the concept of having a very long-term investment horizon. Then there is the potential or drawback of not having enough of a forward-looking perspective by incorporating emerging trends. When it comes to constructing a traditional portfolio, managers often concentrate on specific countries or sectors that they feel they could outperform. On the other hand, thematic investing doesn't specifically benchmark itself against any index and strives to achieve an absolute return goal, rather than just beating a benchmark. Even though benchmarking is an important tool to manage a specific client liability and outcome over the longer term, thematic investing complements this approach to deliver return and risk profiles that can diversify away from disadvantages that approach offers. Eugene, given the value and opportunity in future trend investing, would you mind commenting and detailing Momentum's approach to this investment philosophy? and whether you see this as being different or even better than other approaches you may have seen.
Sure, Jaco. So our thematic approach provides an alternative to traditional strategies by seeking to capture the sources of growth and performance through long-lasting trends to offer sustainable and transparent solutions to our clients. We believe that thematic investing strategies have a very specific role to play in any multi-asset portfolio alongside traditional assets. We believe that having a dedicated focus and allocation to future trends in a portfolio represents the highest commitment and least constrained allocation to a thematic investment strategy, as opposed to implementing subtle tilts in a portfolio towards a specific future view or even an overlay on top of an existing portfolio. Diversification, as per usual, is key in determining the conviction and allocation to certain trends and underlying themes. Risk management and alignment to the longer-term goal of our clients is the cornerstone of the outcomes-based investing approach. Outcome-orientated thematic funds are designed to fulfill a specific objective within a portfolio, which may help an investor weather long-term market changes and trends. Our outcome-orientated thematic fund should provide diversified exposure to market sectors and companies that could already be prevalent in traditional investment approaches. Our unique and innovative approach favors themes where the fundamentals are not only about one specific sector. A broad definition of the investment universe is good for diversification and lowers the sector or stock-specific risk. We have identified these 6 megatrends as important trends that will shape the future of this evolutionary world: climate change, technological innovation, demographic change, lifestyle, space exploration, and shifting economic power. According to the BNP Paribas research mentioned earlier in the presentation, more than 3/4 of investors' main reason for using thematic funds is for exposure to sustainable and ESG solutions, with the leading preference being an overall focus on the United Nations Sustainable Development Goals. That's 41%, followed by climate change solutions, which is 21%, and renewable energy at 18%. Inherent in our thematic fund, we also believe that given the global focus on responsible and sustainable investing, it is imperative to take into account that these SDGs will shape the future. We therefore believe that the megatrends that we identified from an investment and growth perspective also naturally align to these SDGs. Comforting to say the least, given our core focus on making a difference in how we play a role in shaping the future. Besides from identifying the key trends to invest in, perhaps the second largest and important factor around a thematic fund is how to construct a portfolio. Do you keep it as diverse as possible, thereby reducing your risk through a certain trend fail to materialize? Or do you focus on a specific theme, thereby increasing your profit potential should you pick a winner, but also boosting your risk of picking an underperforming theme that does not make the cut? Our approach is to focus on the former, as it directly aligns to our outcomes-based investing philosophy, with a departure point of identifying these megatrends. It is important to recognize that underlying each one of these megatrends, there are multiple sub-themes that shape and form the behavior of a megatrend. An important part of identifying and building the investment case for a sub-theme is information. The importance of big data, potentially even machine learning strategies, can help divulge the noise from the true growth investments. The life cycle of the theme, catalyst to unlock the growth, duration of the theme, as well as the emergence of competition in a specific area of development, is important concepts to take into account when identifying and allocating to a specific theme. As an example, it is often the case that the majority of the growth and returns are generated in the emergence or prevalence phases of the theme playing out, but also poses the most risk of potential failure. Sizing, therefore, does remain an important factor as part of the risk management focus. So, Jaco, given the portfolio construction approach described, how would that practically feature or influence your thinking in practice?
Very good question, Eugene. We don't believe that thematic funds can be managed passively, and the adoption of a set and forget approach does not sit easy with us. Given the rate at which markets, economies, and technology changes and evolves, you absolutely have to have your finger on the pulse. We therefore believe that an actively managed strategy is the prudent and appropriate way to implement and manage such a proposition. We will be executing this strategy in a single fund, focused on specific, research-driven investment themes that is actively managed to relevant, demonstrable investment themes. As I mentioned, this is not a set and a forget strategy, even though we are talking about long-term themes. The underlying themes will be executed through specialist mutual funds or ETFs, which will ensure that we have control over the overall portfolio risk, as well as the allocation to main and sub-funds. We can therefore also manage the mutual exclusivity of themes and the potential for concentration risk that might exist. Alignment to the overall mega trends remain key. One of the key disadvantages raised globally regarding thematic investing is costs. And as you know, that's something we have to manage. It is therefore imperative that we as investment managers have control over the costs and effective execution of the underlying strategy. As we look towards this strategy, there are a few key attributes that are worth mentioning. The Momentum Future Trends Fund will have a long-term investment horizon, and given the nature, the investments in predominantly equity instruments exhibit a relatively high level of risk that is commensurate with the equity asset class. In doing so, our expectation of the fund is that it would be able to generate a return that is higher than that of equity markets over the longer term, while accepting periods of underperformance due to shorter-term market variations. In keeping with our outcomes-based investment philosophy, one of the major roles it would fulfill is that of portfolio diversification. Thematic investing may result in excluding some sectors from the investment universe that are not related to a given theme. And as a result, it is likely to generate substantial performance gaps with the market index, especially over the shorter term. In addition to the portfolio attributes, it is worth standing still on a couple of product specifics as well. From a portfolio benchmark perspective, we will measure and report this strategy relative to the MSCI All Country World Index, especially since the fund will be dominated by global equity instruments or shares. The global exposure of the fund across developed and emerging markets and currencies will also support the diversification benefit relative to traditional equity strategies. Very importantly is the decision to package this solution within a Momentum Collective Investment Scheme, or CIS, as this will allow us and our solutions, including the Momentum Fund of Funds, to access this opportunity set. So Eugene, with that in mind, I think it's worth saying that this is a truly exciting and innovative space that we are moving into. And I'm looking forward to this journey. And I think, as you would agree, we've covered a fair amount of ground over the last couple of minutes. But would you mind maybe just wrapping up with a couple of thoughts and views of your own?
Sure, Jaco. So looking ahead, trends will provide compelling investment opportunities for those who are willing to take a different perspective and concentrate on the bigger picture. Identifying the right trends to consider is essential. Applying a thematic approach is not a simple challenge, but a task worth exploring. Implementing a thematic investment strategy requires accurately recognizing structural shifts, identifying companies with direct exposure to the trend, and then investing into the trend before the future potential growth is fully priced into the earnings forecasts. Identifying trends is a lot harder than it sounds. While successful thematic investors do not need to be clairvoyant, understanding what the future holds does in fact make part of their strategy. Trends that seem steady today can be derailed tomorrow. Therefore, humbleness needs to remain part of this investment journey. Investing in the right trends and themes does not only give us as the investors the opportunity to grow our clients' assets, but also gives us the opportunity to fund the way the future will shape and unfold. As per the familiar words of the renowned Buzz Lightyear, to infinity and beyond. Thank you for joining us today. Goodbye and stay safe.
Our next video is a rather exciting one, which will show you our investment in the beautiful and somewhat iconic Rise Student Living, which is a student village situated only 600 meters from the University of Pretoria.
Student life can be quite exciting. Living away from home for the first time can be quite scary. But the freedom is exhilarating and there's so much to look forward to. At Momentum Investments, we believe that the best way to give our students their best shot at success is to give them a safe place to stay, where they can work, where they have access to all the amenities that they may need, and where they learn so much more than just about their chosen field of excellence. If our students are our future, then we need to make sure that the future starts off right now.
Welcome to Rise Student Living, a student village that has everything a young mind can need and so much more. The building is managed by Eris Property Group, and within this apartment block, we have 299 units with 988 beds.
With access to fast, reliable Wi-Fi, within close walking distance to their campus, and with all the other fun stuff that makes student life memorable right on their doorstep. Oh my word, King Moses. So, King Moses, what are you studying?
I am studying dramatic arts. It's my first year.
And how long have you been living here in this facility?
I have been living here for 2 months now.
Okay, and how has it been?
It's been great. It's been amazing. I actually hardly ever go out because I have everything I need here.
And what does that mean to you, to have access to a computer, to have access to Wi-Fi?
Sometimes my laptop will be acting up. At least I know I have computers where there's access to Wi-Fi, to the internet, everything. And the study area is actually my favorite. It's so warm in here. So studying in here is really nice. It means a lot.
Great, I love your pants. They're absolutely fabulous.
Thank you so much.
I want a pair. Where can I get them?
I actually made these pants yesterday.
What?
I did. I made the pants yesterday. It was a lot, but I love fashion as well. It's one of my passions.
I'd love to actually see the other facilities in the building, what else you have here, what you have access to. And yeah, this is just such a lovely place. I absolutely love it.
There's a lot of beautiful places. Let me show you.
Sure.
So this is like the chill area. It's very cool, right? I love it. I just come here to chill with my friend. I was actually here last night just chilling with my friend and catching up. Being in a big city, you can't always go out, so it's nicer to have places here where you can just go and chill without spending money and just be with friends. And let me show you one of those places. It's just up there. So every unit has a very cool kitchen. I love cooking, but I'm also a meat lover, so it's nicer to just come up here and have a braai or just chill with your mates. And if you're a fitness person or like me doing drama, I have body voice and movement and stuff. We have a very nice gym place where you can do exercise.
Vanessa, thank you so much for welcoming me into your home. As a student, my life wasn't so fabulous. It looks absolutely amazing. How long have you lived here? What are you studying? Tell me.
I've lived here for 2 months now. This is my first year here.
Okay.
Yes, and I'm doing education, a teacher in practice.
Okay.
So it's very nice here compared to living in a campus residence. Now I've grown. I have to look after myself, I have to be disciplined and make sure that I achieve academically.
And I noticed that there's fingerprints and that there's securities and there's cameras, and that's very important to me as a female.
Okay, my safety comes first in everything. So fingerprint scanning is important because not just anyone can come inside the building. Only those who are meant to be here can come in here.
I like it here. I love the morning sunrise and the sunset.
At Momentum Investments, we believe in doing well by doing good. Rise Student Village is a perfect example of this. These students get their best chance at success. This investment provides diversification opportunities while generating returns. Being a part of the ecosystem that underpins and grows our country means so much more than just delivering profits for our stakeholders. It means being an intrinsic part of the journey to success. Thank you for joining us on this tour, and we look forward to sharing more of our great investment stories with you in the future.
Creating multi-asset class funds is a science and an art. To truly remain relevant and continue to meet the needs of investors, this requires a unique blend of these two practices. An inquiring and an open mind that stays abreast of past events and future trends and priorities. In this Capstone panel discussion, the panelists are experts from a local and global perspective and will share insights into how their thinking is evolving to harness the myriad of components affecting multi-asset class funds. What is shaping their thinking? What are they on the lookout for? What worries them? And how they bring it together in an incredible and holistic way. The panel discussion is moderated by Kudzai Ziso, who is a multi-asset class fund manager at Momentum Investments.
Thank you, Gugu. Creating multi-asset class portfolios is both an art form and a science. To truly remain relevant and continue to meet the exacting needs of investors requires not only a unique blend of art and science, but an inquiring mind that's open and stays abreast of past events and future trends and priorities. On the panel today, we have Eugene Botha, who is the Deputy Chief Investment Officer at Momentum Investments. We also have Mohammed Zibda, who is a multi-asset class fund manager at Momentum Investments. Noana Sabopa, a multi-asset class investment analyst at Momentum Investments. And joining us virtually is Andrew Hardy from London. He's the Director of Investment Management at Momentum Global Investment Management. Also joining us virtually from the UK is Justin Crabe-Cox, Fund Manager of the Global Sustainable Convertible Bond Fund at RWC Partners. And finally, we have Peter van der Velle, Global Macro Strategist at Robeco, joining us virtually from the Netherlands. In this capstone panel discussion, the panelists are experts from a local and global perspective and will share insights into how their thinking is evolving to harness the myriad of components affecting multi-asset class portfolios. What is shaping their thinking? What are they on the lookout for? And what is it that worries them? And how do they bring it together in a credible and holistic way? Let me start by asking Andrew a question. Andrew, there is a lot of talk about the science of investing. Where do you think the art of multi-asset investing contributes to the most value?
Sure, thanks. I think the first important thing to recognize is that it's actually hard to separate the two, the art from the science. Let's think of science to begin with as quantitative or rules-based strategies and art as being the more discretionary ones. Almost all strategies out there actually have some, if not significant, elements of both. Quant strategies, for example, actually have a lot of human input, just like compare it to a Tesla, which needs technicians to design the code and a driver as a backstop to supervise as well. And on the other side, no discretionary manager worth their salt wouldn't have a carefully designed and repeatable process that also makes use of large amounts of data in one form or another. So I don't think you need to choose one or the other, would be the point there. And actually, I think in an optimal multi-asset portfolio, and indeed in the ones that we run, we have various elements of both across many different strategies and asset classes. But in terms of where the value add from the art side of things comes from, I think last year is a great example of where you can get that benefit. Dealing with a virtually unprecedented scenario like the pandemic, where there's no truly comparable scenario in the past to model from. So that makes it difficult for more quantitative strategies based on historical relationships and the like. And you think on your feet and need to adapt and evolve processes. So that means drawing on experience and judgment, which is ultimately more art, but art that can apply to both quant and discretionary type strategies in order to ultimately protect capital in portfolios and take advantage of the opportunities that the dislocations in markets have provided. So a few more specific examples of that, I'd say managers like ourselves, multi-asset, multi-specialists, were well positioned to be able to pull in the viewpoints and think of it as bottom-up intel from many of the best specialist managers from around the world to help us get a clearer view of the investment landscape, the risks and opportunities out there. That, just an example, that happened in convertible bonds last year, something which I'm sure Justin will touch on in a bit. And then also huge volatility and dislocations again last year threw up many opportunities within specific asset classes, which turned out to be very mispriced. And so the very best specialist discretionary managers out there were able to build high conviction positions in these, so large positions in those where they had the most faith that at some point there'd be a very good return accruing to investors, despite the uncertainty. And you need to do that through mosaic analysis, very deep fundamental research, and understanding of businesses generally to be able to build that much conviction. But the end result was outsized returns and a lot better than many quant strategies typically would have delivered, because quant strategies need to be that much more diversified and take lots of smaller bets to harvest risk premium over time typically. So in strategies you can get ultimately better alpha from a more concentrated fundamental approach.
Thanks, Andrew. We definitely saw things we had never seen before in 2020, so I would definitely agree with you there. Then Peter, a question to you. You just released your 5-year expected returns and had a conference themed the Roasting 20s. This title provides both a future focus as well as bringing the theme of climate change to the fore. What do you believe are the key trends and issues facing investors over the next 5 years and longer?
Well, in our view, for the next 5 years, we see a huge step up in investments to facilitate the green transition, as our planet is clearly heating up. And the latest warning shot about that has been fired by the IPCC, the International Governmental Panel on Climate Change, who state that even in the next few decades, even in the most benign carbon emission reduction scenario, we are still faced or confronted with 1.5 degrees additional warming above pre-industrial levels. Now, we do expect that governments will heed this warning shot fired by the IPCC in the forthcoming COP26 conference, and as I said, will step up their investments. So that means that there will be a lot of roasting going on in the metallurgical sense of the word roasting, because when you look at renewable energy, wind turbines typically require 9 times the amount of steel compared to a natural gas-fired plant, for instance. If you look at electrical vehicles, a Tesla requires 4 times the amount of copper compared to a fossil fuel-driven car. So there will be a strong increase in metals and mining demand from that green transition. And we also have a third angle to our roasting theme, and that is that we do envisage some roasting going on in the corporate landscape. At this point in time, you don't see creative destruction, as Schumpeter called it, but we do expect on a 3 to 5 year horizon that there will be a creative destruction, and that the laggards in each industry and sector will feel the heat of new competition. What do I mean by that? If you look at startup activity over the past 18 months, then there's a huge increase. For instance, in the US, 4.3 million new startups have been registered. And that means that those startups, which are often riding the wave of digitization, are able to compete with the existing competition for market share. So our global growth trajectory has been upgraded because we are more positive now compared to last year on the supply side of the economy. We see a boost to the supply side. Also, when you look at current CapEx intentions, then corporates are now envisioning a higher capital spend, which will typically lead productivity growth with a considerable lag of three years. So over that time horizon, 3 to 5 year, you could see a notable step up in productivity growth in the advanced economies as a result of increased CapEx spending and high current startup activity.
That's very encouraging to hear, about 4 million new startups being registered in this last year. So I'd like to pose my next question to you, Peter. And Andrew, if you wouldn't mind weighing in on this as well. Is now a good time to invest overseas? And what worries you the most about this? Peter, let me start with you.
So when you look at our investment framework, Starting with valuations, then we find especially US equity valuations and also US high yield valuations quite stretched from an absolute perspective, historical perspective. And just looking, for instance, at the Shiller Cape, the cyclically adjusted price earnings ratio, which is now at 38, has only been higher once in the last 120 years during the heydays of the IT bubble. Looking at the subsequent historical returns at such a high level of Cape, then you should even see negative returns for US equities going forward. However, starting valuations are just part of the story. So subsequent returns are only explained around 25% by starting valuation levels. So the bulk of the return variations on a 5-year subsequent horizon is explained by the macro factor. So while we think that we are seeing a multiple compression in the US vis-a-vis other regions like Europe or Japan, we do think that earnings growth also in the US will be quite decent because we do envisage around trend growth for US economy. And given the operational leverage US corporates have, you could see low double-digit earnings growth in the US, despite the multiple compression we do envisage. Overall, we think that Europe and Japan, more high beta regions, will be able to outperform US in the course of the next 5 years because they will suffer less from multiple compression due to lower starting valuation levels.
I would agree with Peter's comments there, but maybe come to the questions from a different angle. So on now a good time to invest overseas, I'd say the answer is nearly always yes, actually. And the right question is, in fact, how much should you invest overseas? And the reason I say that is because global is such a vast opportunity set. It's such a wide range of different growth drivers, asset classes, managers, etc., many of which aren't available in the domestic South African market. And harnessing those effectively can massively increase your chances of delivering on targeted outcomes in portfolios. And just to put some numbers around that, the South African economy represents about 0.5% of global GDP, and the stock market capitalization is a similar proportion of the MSCI 80 World Index. And that benchmark captures some 15,000 companies listed globally, and 99% of the global equity investment opportunity set. So put another way, a South African-based investor who restricts investments solely to domestic stocks is leaving behind 99.5% of the equity opportunities globally, give or take. And thinking long term, it is very hard to successfully time markets. And going back to the old adage, it's time in the market that is actually much more important. And then on the risks side of things, valuations are certainly up there. And there are many other shorter term risks that investors have been focusing on lately. The China problems around Evergrande, the US debt ceiling, etc. But these are often factors that drive volatility higher in markets in the short term. And long-term investors should really welcome those for the opportunity that they bring if you're active. But the biggest risk that we worry about at the moment, and indeed many other market participants, is around inflation. And particularly the risk that the current upswing could prove more persistent than many are expecting at the moment. Why worry about that? Well, inflation is just one of those things that once the inflation genie is out of the bottle, it's very hard to get back in again. And sustained higher inflation could have a very significant impact on valuation levels across most asset classes globally. And you've got to recognize that after 30 plus years or so of low inflation, there's a risk that investors are too complacent at this stage about what higher inflation might mean for portfolios going forward, although clearly it's getting a lot more attention. How do we deal with this? I think it calls for effective diversification in portfolios first and foremost, and making sure that you have enough assets in portfolios that can perform well in a higher inflation environment. So that would be things like commodities, infrastructure, property, and the like, and also more value-orientated parts of equity markets as well.
Great, thank you, Andrew. Now, just moving on to Eugene. You're very close to the investment research and asset modeling. I've heard you talk about some interesting topics. So what are the current and future research focus areas for Momentum Investments?
Sure, thanks, Kudzai. So, I mean, at Momentum Investments, we believe in an evidence-based approach to investing. So sound and thorough investment research alongside detailed analytical evidence goes a long way in identifying unique investment opportunities, as well as help you improve on your risk management processes for whichever way you want to define risk. Now, with our dedicated investment research and innovation hub, we have identified a couple of core focus areas or pillars from a research perspective that we deem important for our clients. And I want to mention 3 of them. So the first one is the broad pillar of investment management. And within that pillar is anything from innovative portfolio construction. It's about responsible investing and how we actually measure the impact of those kinds of investments. It's about alternative assets and alternative payoff profiles and how those assets fit alongside your traditional asset classes in a portfolio. And it's also about your future trends and innovative ideas and how we incorporate those in a portfolio. The second focus area is about clients. So it's for us about understanding the psychological behavior of clients through different market conditions and how these behaviors actually impact their investments so that we can ultimately nudge our clients to make investment decisions that are right for them as opposed to what feels right for them. Right? And then the third pillar for us is about technology and you know, how we actually apply technology in the first 2 pillars that I've mentioned. So examples of that is, you know, how do you incorporate big data or machine learning techniques in our existing processes for us to ultimately enhance our investment research, the investment decision making, and ultimately enhance the client outcomes as well.
Thanks, Eugene. I certainly find it fascinating how technology is fast-pacing the way in which we manage our portfolios. Moving on to you, Mo, you often talk about all the things that you're always thinking about, you know, at all different points of the day. So what are some of the top-of-mind issues for you as a multi-asset class portfolio manager, and what are you looking to incorporate in the future?
Yeah, thanks, Kudzai. I think, you know, maybe as just to start off, I think Andrew has probably encapsulated most of the shorter term risk that, you know, I think most investors would probably agree upon. So for example, you know, what happens in an inflationary environment, something most investors have not seen in their careers over the last 10 to 15 years, what impact that might have on asset classes, on future returns, etc. And then again, you know, for example, many of us have grown up in a very low interest rate environment, and what happens in the case of, you know, a normalization of monetary policy. Granted, they've been talking about it for the better part of 10 years, but at some stage, you know, we will see high interest rates coming to the fore, and what impact that might have on the shorter term returns. So the way I like to answer this particular type of question is, you know, what are the impacts on the shorter term, and then maybe extending the time frame, you know, to a medium to longer term. So if, for example, if we just maybe then just focus on the shorter term, you know, if, for example, you know, the relevant monetary and authorities, you know, decide to raise interest rates, what are the impact on their portfolio returns and the likelihood of those persisting, you know, if for example, those are lower returns. Is it just, you know, to use quite a common word being thrown around now, is it just transitory or is it temporary? You know, are we going to see, you know, shorter term returns? And then maybe just touching on what Andrew said earlier, you know, maybe it might just be an opportunity then to increase, you know, the exposure to your growth asset classes, assuming they actually get sold off. If we then focus on the medium and longer term, which I think is probably, you know, more topical, if you like, is, you know, the high probability of, you know, lower returns from your traditional asset classes going forward, whether it's from you know, from a valuations perspective or whether it's just from an economic perspective, that, you know, you might just experience lower longer term returns specifically from your traditional asset classes. So what we're looking at obviously at the moment is, you know, including the exposure to your alternative asset classes, specifically your real asset classes. And again, I think, from the real asset classes, the reasons that we're looking at that is firstly, from an outcomes-based perspective, it fits the profile, perfectly. It gives you that inflation-type returns that you can experience over a period of time. You know what you're signing up for example. And then again, it has generally lower volatility compared to your traditional asset classes. And I think probably more importantly, for South Africans, it has this huge, a focus on social development and economic upliftment, if you like, for the country. And again, it's a strong focus area, for the broader team at the moment.
Okay.
All right.
Thanks, Mo. I really like the social aspect of that. But I just want to stay with you a little bit more, and I'd like to get your point of view on this as well, Andrew, if you can. Should investors and their advisors be considering allocating to private assets alongside their liquid investments? Just answer that.
So again, I think maybe we think it makes sense for investors to look at private assets for the reasons that I explained earlier. It's not just from the risk and return perspective, but we think private assets has a role from the sustainable development perspective. So for example, we've got quite a few strategies that with a strong focus on job creation. And one could argue in probably a job retention in our environment is probably more important. And we've got quite a few of those underlying investments where there's a strong focus on job retention at the moment. So we think private assets, that this not just the payoff profile that you can experience over a period of time, but all the other added benefits that come with private assets. So for example, the social aspect which I explained earlier, but also in terms of the illiquidity premium that you get from private assets, because these assets are not mark to market on every given day. So you almost smooth out the volatility of the portfolio of the actual assets.
Okay.
Yeah.
All right. Okay. Thank you. And Andrew, would you like to weigh in on that?
Yeah, I'd 100% echo Mo's comments there and say absolutely investors need to consider allocations to private markets in their portfolios. To be specific, not as a short-term tactical call, but as a long-term component of strategic asset allocation. Introducing it pushes out the efficient frontier so you can achieve the same with a lower volatility or a higher return for the same volatility. And then thinking about the global opportunity set, private equity, of course, is one of the most obvious areas to consider for private assets, and arguably the most important. And an important dynamic to which we've seen very clearly in the UK and the US and indeed other markets is that companies are choosing to stay private for much longer than they used to. They don't need access to public markets as early in their life cycle as was the case in past decades. So Amazon's a great example, obviously a behemoth now, but it was founded back in 1994 and listed only 3 years later. So public equity investors were able to buy shares in it then when it was less than $1 billion in market capitalization. The situation is very different today. Many very, very high growth businesses at the moment are still private, even on valuations of 30, 40, 50 billion already, with no plans to list anytime soon. So if you're not allocating to private assets, then you're missing out on the growth opportunity in many businesses like that. And it's becoming more and more of a problem, I would say. Other private asset areas, private debt also offers a rich opportunity set. And there, specifically, I think you can harvest additional liquidity and complexity premium in that area by being a provider of capital to bespoke deals or in areas where have particular needs beyond just capital. Then, of course, there's property and infrastructure assets, which are other areas where there's a rich opportunity set in private markets, as most spoke to. And then, the final point I make is just that investors who can lock their assets up for several years, greatest investment universe in private markets. But there are many liquid investment trusts and closed-ended funds and the like that do offer to pretty focused portfolios and managed by specialist teams. And we use those extensively in our liquid portfolios. So it's a means of getting access to private assets, but in a semi way and through an appropriate security. Doesn't introduce a liquidity mismatch into liquid multi-asset portfolios. And that's, on our side, that's been incredibly in recent years. Some equity investments have delivered triple-digit returns, and we've got several other investments at the moment that are delivering very high single-digit yields, which is something to make the most of in this very low yield environment at the moment. But one final point is that typically we're dealing with more focused portfolios here with more idiosyncratic risk and less information readily available. So I'd stress that it's very important to have enough research resources to adequately cover and access this area.
Thanks, Andrew. Now, a question for Noana and again to you, Andrew. Private assets tie in very strongly to the theme of ESG and SDGs. And both of these are becoming increasingly relevant in the world of investments. And it has become more apparent that they should be considered or integrated as part of the investment process. Noana, how do you ensure that you keep abreast of ESG issues or developments within your portfolios?
Thank you, Kudzai. So as asset allocators, we believe that we have a responsibility and duty to our clients to ensure that we hold our fund managers accountable for taking ESG very seriously in their portfolios. So whenever we engage with these fund managers during our due diligence engagements, we need to start ensuring that ESG is no longer the last item on the agenda. In fact, it should be one of those issues that we thoroughly interrogate with the asset managers whenever they come to us and they present their investment philosophy and process. And also how we now approach ESG in our portfolios. We make sure that integration does not compromise on returns and ultimately our client experience. However, it does become very beneficial for us when we do decide to partner up or invest in companies or projects that are more sustainable and are of higher quality. And also it is important that we partner up with those companies that are good social citizens. They have solid governance inside, and also whenever there are social issues that do arise, they do take the steps, to try and resolve them and work together with the communities around there. In one of our other markets where we've embarked on a very similar project, the payback period for that particular project was going to be 19 years, which would have resulted from the reduction in tariffs. However, we chose not to pursue that particular project further. And the reason why I bring this up is to demonstrate that when we do partner up with companies or invest in such projects, we do not invest solely based on the nature of the project. Mm-hmm. We, however, prefer to have a holistic view of that particular project and have a better understanding of the benefits that we should expect to filter through to our clients and ultimately to our portfolios as a whole.
Thank you, Noana. Andrew, would you like to weigh in on that question as well?
Yeah, sure, thanks. So we follow a integrated ESG approach, and that means that across all of our investments, we bring ESG risks and opportunities into the decision process. There's very many different ways of integrating ESG into a given process. Some lean more heavily on exclusions, some more on impact. And like we do have some select exclusions in portfolios, and we have some investments that are more impact orientated. So energy storage companies is a recent one we invested in, and digital infrastructure as well, where there's a great growth opportunity as well, and you're well compensated as an investor, and clearly there's a need for capital there, and so good ongoing return opportunity. But the key thing I'd emphasize is, as I said at the outset, we integrate ESG across all investments, and we do that in many different ways. So first and foremost, we do it by being very close to our investments, so doing deep due diligence prior to making any allocations and ongoing reviews along the way as well, so that we can explore any ESG issues that are there already or arise over time. And then that's complemented with a lot of internal debate around specific ESG developments, characteristics, risks, etc. Then ensure that we get good reporting and transparency from all of our underlying investments, whether it's a specific company or a third-party manager. So that might be detailed proxy voting reporting or carbon disclosures or many other elements of ESG-related risk reporting. And then specifically when an issue arises, we will routinely engage with management or boards to try and resolve that, improve that, or generally support the principles of responsible investment that we're signed up to as a group, and other stewardship best practice. And we've always been doing this. I mean, it's built into what we do in terms of that deep research. And ESG has always been a factor within that, but it's clearly garnering more attention now as regulation increases and the standard that companies need to be held to increases. So we're well positioned to evolve our approach as those circumstances change. So I'd say that active management in general has an advantage over more passive styles in that regard as well. And then the final thing I'd add is just that we maintain good governance of ourselves as well. So rather than just holding our managers to account, we hold ourselves to account as well. So that's through having responsible investment committees internally and through making sure that we report to our investors in a detailed and appropriate fashion. So that could be through the UNPRI annual and in the UK, our stewardship code reporting as well.
Thank you, Andrew. It's clear from both of your viewpoints that ESG is definitely one of the mainstays of our investment process. Now, I'd like to just ask some of the panelists some of the opportunities that they come across in their areas of investments. Justin, there are investments that don't fit neatly into traditional asset classes. One of these is convertible bonds. Convertible bonds have features of both equity and debt and allow you to receive yield in a world where yield is scarce. What are the advantages of introducing convertible bonds to an existing balanced portfolio of equities and bonds? What drove the outstanding outperformance of convertible bonds as an asset class that we saw in 2020? And can such a strong risk-adjusted return base be sustained over the long term?
Thank you. I believe that the answer comes in two themes, really. Andrew's mentioned some of them, which are having overlooked asset classes can create opportunities for active managers. And secondly, the efficient frontier. And by that, I mean that introducing convertible bonds to a mix of equities and bonds themselves brings diversification benefits, allows you to earn more return taking on less risk. So as a specialist asset class, convertibles can be overlooked, but they're actually growing in size for reasons that I'll mention when we discuss 2020 performance. Right now, the convertible bond asset class on a global basis is about 1/3 the size of the global high yield bond market. So if you are allocating to high yield bonds, convertibles are definitely worth considering and introducing. So what exactly are convertible bonds? You have a corporate bond plus an option embedded in the bond where you can convert into stock. So what you receive is the upside potential that comes from stocks. You also have capital preservation from a bond. Right now is a good in-between moment for convertibles because the opportunity cost in bond investing are actually quite high. As other panelists have mentioned, yields are quite scarce, and we're seeing that the opportunities to earn more yield are fairly limited, so switching out of bonds makes sense. But if you leave equities where there still is some potential for return and move into cash or bonds, that's also a lot of opportunity cost. So if you look at the diversification benefit with convertibles, first, that option-like exposure. It's not a directional call. You're not going all the way into stocks or all the way into bonds. you have a different set of credits, because one thing that is important to know is not all companies have a convertible bond. Those that do are often more growth focused or are looking for some sort of change in their business. Now, this introduction of convertible bonds means that you have a difference when it comes to looking at that standard equity and bond exposure you have in a portfolio. Now, how did convertibles perform so well in 2020? I would say that it's because you had volatile markets. The more volatile markets are, the more up and down activity you see, the better convertibles do on a relative basis. So if we look at the real depths of the pandemic and saw what happened to bonds and what happened to stocks at that time, yes, stocks fell, bond credit spreads widened, particularly for high yield, but convertibles bond floors held because many of our issuers are a mix. This is investment grade and high yield equivalent.
Thank you, Justin. That's very insightful. Let's talk about ESG trends. How do you think about the trend of ESG? And does the ESG factor contribute positive alpha in this asset class? And how do you analyze these investments through this lens?
We very much believe that ESG analysis helps to generate alpha. We would define for our world, ESG is a way to look at companies' financial impact from non-financial sources. And we want to measure both risk, but also possibility for return. So where we see this analysis is most helpful is, I think, on a bottom-up and integrated view, very active in our approach. So we don't use lots of rules and exclusions. And the reasons, if I mentioned to you that convertible bonds, not all companies have a convertible, it wouldn't make sense for us to compare our issuers against all possible companies and try to rank them. Also, if we compared only convertible issuers to one another, that might not be a wide enough sample. So we see this case-by-case view as really being the most appropriate. What we'd like to find are companies that have been able to manage ESG risk or that have a plan for the future. We want to see companies that might also be improving. They don't necessarily have to come from the strongest or best-in-class base today, but we'd like to see them adopting either policies or key performance indicator, any kinds of outputs that we can track and make sure that they are executing on what they say they are doing. So we focus our company analysis on looking at both third-party research to tell us more about these issuers, but also in performing our own, what we see as in a very key independent analysis. And that analysis has 12 parts where we divide them amongst ES and G factors. And so we're trying to understand, again, where has the company come from and where is it going to? We also look at companies that have issued green bonds. Green bonds we see are very important for signaling real intent, but they've also agreed upon a framework that says we are going to invest the proceeds of these bonds into projects that are going to either lead to some sort of mitigation of temperature rises, will be invested in cleaner technology, or to help companies decarbonize. And finally, we see in our market a few sustainability-linked bonds where those key performance indicators that I mentioned are actually part of the coupon repayment. And if companies don't hold themselves to account, that means they might have to pay us more. Now, we're not looking for these companies to get in trouble so that we earn more. We want to invest in companies that are willing to commit to doing the right thing in the future, but have worked out the right steps for that business and within that sector.
Thank you, Justin. Noana, I'd just like to come back and circle back to you in terms of the SADC region that you look after. Do you find that you can generate enough alpha in the Africa ex-SA space purely by managing traditional assets?
Kudzai, in the short term, not entirely. Because opportunities in this region are few and far between, one has to constantly be on their feet to try and find innovative ways to generate short-term alpha in our portfolios. Alternatives can actually work in the region as a long-term strategy. However, portfolio sizing, position sizing is very important when you go into such asset classes because you have to be cognizant that you don't overexpose your portfolios to illiquid assets. But what we have also found in our space in particular is that banking institutions are more and more growing in popularity in providing cost-effective solutions for liquidity in this region whenever it is needed. And outside of looking at issues inherent within the portfolios themselves, when you're operating in the SADC, in Africa as a region in general, you have to be constantly learning and understanding the environment in which you operate. And one of the key things that one has to constantly be on the lookout for is the regulatory landscape in those different regions, because there are constant changes that take place within these regions. And the best way to try and make sure that you're always up to date with all the information is fostering and building very good relationships with the various stakeholders within the regions. And just on the last point, as while we are long-term investors within this region, we don't often churn our portfolios. But that does not mean we can relax and think that nothing is going to happen. We cannot be caught off guard. Mm-hmm. Therefore, it is very important to stay ahead of the game, constantly doing scenario analysis and trying to find ways on how we can actually approach those issues as and when they arise.
Thanks, Noana. Then as a last question to all the panelists, I think I'll start with Andrew. And if you can just give me one word as to which one asset class or strategy would you invest in if you could only invest in one, and if you had to hold it for 10 years. So I'm just going to go across all the panelists and just one asset class or strategy over a period of 10 years. Andrew, what would your answer be?
Sorry, I'm going to stretch it to a few more words, but global value equities.
Okay. Peter?
I have the same answer, value equities.
Okay, Justin?
I'd have to say convertible bonds. They have exposure to equities, but they're short duration and should protect well against inflation should we see it. And I think volatility is mispriced and they do well in volatile markets.
I think you've converted us. Mo?
I think local bond managers will love me for saying this. It's 10-year South African government bond.
Noana?
I'm inclined to go with equities.
And Eugene?
So for a 10-year investment horizon, my focus will be on global equity with a focus on the future trends that will shape the futures to come.
And just in terms of our discussion today, what has really come across is how we need to think about what's happening in the future and how the past has shaped that. We've seen how ESG has taken center stage in terms of our processes, as well as looking at asset classes that we hadn't really thought about in the past, like convertible bonds, as Justin brought to the fore. In this session, we have heard how exciting the future of multi-asset class management is. It is a complex and future-focused endeavor with a lot of opportunities and trends to exploit. Thank you to the panelists, as well as our overseas speakers, for such insightful contributions.
Now, this conference has covered a lot of ground over the last 3 days. But to help provide a summary are Bafana Motsweni and Paulina Mwenda, who are Momentum Investments' latest investment interns. Now, this should tell you something, that Momentum Investments is committed to growing and developing people and giving them real exposure and opportunities. This remains a key initiative to develop the human capital of the future.
Thank you, Gugu. The last 2 days have been so exciting for me. As one of the first 2 interns in the Phambili internship program, this was an amazing opportunity for me.
Absolutely. The last few weeks have been a whirlwind for me, and being part of this conference was fantastic. I've gained so many insights into how the strategy behind the strategy works. I was able to interact with so many people I will be working with.
And for me, I've been exposed to so many divisions that make up Momentum Investments.
So, let's take a look back on some of the highlights from the last few days. Once again, to all of you attending, we look forward to seeing you next year.
And hopefully, in a year or two, I may be presenting to you from this very stage.
Theo Terblanche, the Executive Head of Investment Management at Momentum Investments, concludes the conference and provides an update on the Momentum Investments business.
Thank you, Gugu. Good morning, everyone. The theme of our conference this year was Empowering the Future. And how fitting was it to listen to our young interns, Bafana and Paulina, summarize the conference for us. It's a privilege for us as a business to be part of empowering the future for the younger generation and also our industry. And through our Pambili internship program launched earlier this year, we aim to do exactly that. The last 18 months have been eventful, and the speed of change around us has increased dramatically. Last year at our conference, we were still pleasantly surprised by the quick recovery in global markets since the onset of COVID, and cautiously optimistic that it would continue. The second wave of infections in South Africa was gathering pace, and vaccines were still a distant hope. Move forward 12 months to today, and the optimism has been replaced by inflation fears and central banks planning policy tightening. Large parts of the developed world are planning booster jabs for their citizens most at risk, while in South Africa, vaccine hesitancy is slowing our efforts to fully emerge from lockdown restrictions. Through all of this, businesses like ours had to adapt quickly to these changing circumstances, not only in ensuring decent investment outcomes for our clients, but also in serving our stakeholders like the communities within which we operate, our shareholders, and staff alike. Rest assured that at Momentum Investments, we believe in creating long-term, sustainable investment outcomes for our clients and keeping them invested and focused on the right outcomes. We design our solutions with our clients in mind and spend all of our time and effort making sure our clients get the best outcomes. With us, investing is personal. It's been a busy 3 days, and over the course of the event, you would have gotten good insights into the range of capabilities offered by Momentum Investments and how our portfolio managers position their portfolios to navigate the current outlook. Importantly, throughout the event, you would have heard how important it is for us as a responsible investor to make sure our investments and our investment approach have a positive impact. An impact not only for our investors by maximizing their ability to achieve their financial goals, but also on society at large in helping secure a more sustainable future for all. This approach permeates throughout our business and across all asset classes, and each has a role to play in allocating capital to initiatives that help shape the future. You'd have seen several videos today showcasing the real and measurable impact our investments has had on community. Whether it's a new solar plant in Karoo's Hoek, student accommodation in Hatfield, Pretoria, or empowering women within our own business, we're proud of what we've achieved over the last year, and we're committed to having an even greater impact going forward. This year, our conference was structured around our 3 businesses within Momentum Investment Management. The first day's focus was on Momentum Asset Management and the traditional asset class capabilities we specialize in. We have a long and proud history in fixed income, and our experienced team have been managing assets over a long period and through many market cycles. We offer a full range of portfolios across the risk spectrum and have recently added a corporate money market fund to our offering to assist corporate clients looking for cash returns while not taking excessive credit risk. We follow a systematic approach to equity investing and have over the past 3 years built up a significant asset base and an enviable track record in our range of passive and smart beta portfolios, going toe-to-toe with some of the best active managers in the market. This approach has many benefits, aside from the lower cost appeal and good performance track record. It fits neatly into portfolio design processes for capital allocators, and we believe the trend towards this approach will continue in South Africa. While property has borne the brunt of the pandemic and changes in the way we live our lives daily, we still see value in the asset class in the medium to long term, and we offer a range of listed property portfolios for clients that want to include this in their portfolios. On the second day, the focus was on Momentum Alternative Investments and the important role alternative asset classes play in diversified opportunities to construct portfolios, especially in a lower growth environment. These asset classes also afford us the opportunity to play our part in empowering our future in South Africa. We're excited to have shared our new range of impact funds with you, which we launched over the last year. Additionally, we also offer a range of hedge fund of funds, private equity, and a high-yield credit capability, which you heard about yesterday. Today, Momentum outcomes-based solutions took center stage, and you heard our multi-asset experts talk about solving for clients to reach their financial goals, but also having a positive impact in society. We are pioneers in the outcomes-based investing approach in South Africa, and have spent a lot of time and research on refining and improving our approach to the benefit of our clients, through collaboration with our London colleagues, but also our offshore partner, Robeco. An example of this is the new Global Trends offering, which we've incorporated into our multi-asset portfolios and will make available to clients shortly. I hope you also had a chance to attend our think tank webinar, where some of the best minds in the world shared some of their views of the future. If not, you'll be able to see it on our website. Other highlights and focus areas in our business over the last 12 months include the establishment of a research and innovation hub in our business. This brings specialist skills from across our business together to focus on researching and developing new ways of understanding our clients and their behavior, innovative technologies, as well as new investment ideas. There are various themes informed by our research and insights from the Research Hub, which focuses on future-proofing our portfolios. The continued cost saving we managed to pass on to our clients by virtue of portfolio innovation. Launching our Pambili internship program mentioned before. This not only helps us play our part in empowering business leaders of tomorrow, but also assists us in our endeavor to responsibly transform our business over time. The development and successful rollout of a methodology that gives us insight into investor behavior and how best to position our portfolios and platforms to maximize long-term returns on the back of these insights. The continued progress and good feedback from the United Nations Principles for Responsible Investing in terms of our responsible investing practices across all our capabilities and portfolios. And lastly, our progress on continued integration of ESG factors into our investment portfolios and the second edition of our stewardship report to be released shortly after this conference. Please also look out for our Minefields newsletter that will showcase our responsible investing thinking in even more detail. This brings us to the end of our annual Investment Matters conference. It's been a privilege once again having you with us over the last 3 days, and I trust that you've enjoyed the variety of topics covered with us. If you would like a recap of some of the content, or if you missed a session or two, I'd like to remind you that a recording of each session will be hosted on our website on momentum.co.za under the Investments and Savings tab. CPD certificates will be emailed to you once the CPD points have been authorized. Thank you again for your support and for attending our Investment Matters conference. I look forward to speaking to you again soon. Until then, please stay safe.
Well, we hope that you enjoyed the final day of the Momentum Investments Annual Investment Matters Conference, which was a showcase of a rich and broad range of thought leadership from South Africa and around the world. I trust that you found this as thought-provoking, inspiring, and insightful as I have, and that this is information that you, as a key partner to Momentum Investments, will implement in your day-to-day approach in investing. We look forward to seeing you at our future events. Until then, keep safe and take care.